In Part 1, we expose the pattern: Jekyll Island, 1929, 2008, 2020. Every crisis, the same playbook. The Fed prints money, Wall Street gets first access, you get the inflation. We ended with the reverse repo facility, the mechanism that lets them inject trillions into asset markets while technically removing it from circulation before consumer prices explode. Now I'm going to show you exactly how this wealth extraction machine works, step by step, dollar by dollar. By the end of this video, you'll understand why you're working harder and getting nowhere, and it's not your fault. Quantitative easing is essentially counterfeiting with a government charter. When you or I create money out of thin air, it's a federal crime. When the Federal Reserve does it, they call it monetary policy. The only difference is permission. Here's what actually happens. The Federal Reserve, which isn't federal and has no reserves, creates money digitally with a keystroke. They use this conjured money to purchase assets, primarily treasury bonds and mortgage-backed securities, from authorized banks. No printing presses, no physical currency, just numbers changing in a database. As Ben Bernanke, former Fed chairman, admitted in a 2009 60 Minutes interview, we're not printing money, we're crediting bank accounts. A distinction without a difference. In theory, here's the innocent explanation of how quantitative easing is supposed to work. Imagine the economy is a patient in cardiac arrest. Credit markets are frozen. Banks won't lend, businesses can't borrow for payroll, consumers can't get loans for cars or homes. Economic circulation stops. The Fed steps in as emergency responder. By purchasing treasury bonds and mortgage-backed securities from banks, they inject liquidity into the system. Banks now have cash on their balance sheets. This theoretically encourages lending. Businesses get loans, hire workers, economy recovers. It's presented as a temporary emergency measure, like a defibrillator for the financial system. Once the patient stabilizes, you remove the paddles. The Fed would sell those assets back, shrinking their balance sheet, removing the emergency money from circulation. That's the version taught in economics courses. That's what Ben Bernanke testified to Congress in 2008. That's what Janet Yellen explained in soft, grandmotherly tones to concerned senators. It sounds reasonable, professional, scientific monetary management. There's just one problem. But here's the trick. The banks receiving the newly created money don't have to lend it to small businesses or consumers. They can do anything they want with it. And what they did was predictable. They used it to purchase assets that would appreciate when flooded with liquidity. In 2008-2009, as the Fed created $1.25 trillion to purchase mortgage-backed securities, JP Morgan Chase used its liquidity to buy Bear Stearns for pennies on the dollar. Bank of America absorbed Merrill Lynch. Wells Fargo took over Wachovia. The mechanism was simple. The Fed bought toxic assets from these banks at inflated prices, meaning the banks got bailed out at par value for securities that were essentially worthless. Then, those same banks used their restored balance sheets to acquire collapsed competitors. Goldman Sachs in 2009 alone paid out $16.7 billion in bonuses. The same year they received $10 billion in TARP bailouts and billions more in indirect support through the Fed's asset purchases. Let me read you exactly what the internal Goldman Sachs Compensation Committee memo said. These financial results reflect a return to market-leading performance across our core franchises. Market-leading performance, with government money, during the worst financial crisis in 80 years. The loophole was simple. Nowhere in the Federal Reserve Act does it say the banks have to use emergency liquidity for its stated purpose. The Fed creates money, buys assets from banks, and then those same banks are free to deploy that capital however they choose. And they chose to get richer. But that was just round one. By the time we got to 2020, the mechanism had been perfected. When COVID hit, the Fed didn't hesitate. In March and April 2020 alone, they created $3 trillion. By the end of 2021, their balance sheet hit $9 trillion, double what it had been just 18 months earlier. The CARES Act authorized $2.2 trillion in government spending. Where did that money come from? The government doesn't have $2.2 trillion. It borrowed it by issuing treasury bonds. Who bought those bonds? The Federal Reserve with newly created money. This is the part that'll make you sick. While you were waiting for a $1,400 stimulus check, the Fed was purchasing $120 billion per month in Treasury bonds and mortgage-backed securities. That's $4 billion per day, every single day, for 18 months. Where did this money go? Let's follow the trail. Stock market. The S&P 500 was at 2,237 on March 23, 2020, the pandemic low. By January 2022, it hit 4,818, a 115% increase in less than 2 years, the fastest recovery and bull market in history. Who owns stocks? The top 10% of Americans own 89% of all stock market wealth. The bottom 50% own essentially zero. Real estate? Home prices increased 43% between January 2020 and December 2023. The median home appreciated by $120,000 in 3 years. Who owns multiple properties? Investors and the wealthy. First-time home buyers? Priced out entirely. Corporate debt. For the first time in Fed history, they purchased corporate bonds. They created a $750 billion facility to buy corporate debt, including junk bonds from airlines, cruise lines, and energy companies. This literally wasn't legal before 2020. The Fed changed the rules mid-crisis to directly subsidize corporate America. Now, here are the statistics that should make your blood boil. 93% of financial assets purchased by the Fed went to institutions, not individuals. The top 1% gained $6.5 trillion in wealth during COVID. The bottom 50% lost ground even with stimulus checks when adjusted for asset price inflation. Billionaire wealth increased by 70% between March 2020 and October 2021. Workers' wages increased by 4.5% in the same period. Let that sink in for a second. They printed trillions, called it relief. You got enough to cover 2 months of rent. They got enough to buy your entire apartment building. Here's where this stops being historical analysis and becomes your life right now. You're working harder than your parents did. You're more educated, more productive. Technology should have made everything cheaper and easier. Instead, you can't afford what they could. Your grandfather bought a house at 25, working at a factory. You have a bachelor's degree and can't afford a one-bedroom apartment. This isn't your failure. This is engineered extraction. Every time the Fed creates new money, they're diluting your purchasing power. But the dilution isn't distributed evenly. The new money goes to asset owners first. They buy assets at pre-inflation prices. By the time that money reaches your paycheck, if it ever does, prices have already adjusted. You're always last in line, always paying inflated prices, always watching assets appreciate faster than you can save. Here's your situation in concrete terms. Housing. The Fed keeps mortgage rates artificially low to stimulate borrowing. Sounds good for buyers, right? Wrong. Low rates mean investors and institutions can borrow cheaply to buy properties they rent back to you. You're competing against BlackRock with a Fed-subsidized line of credit. Retirement. Your 401k requires decades of compound growth to retire. But every round of money printing devalues the dollars you've saved. Your $500,000 retirement account in 2050 will have the purchasing power of maybe $150,000 in 2024 dollars. Wages. Your employer can't keep raising your salary because their input costs are rising too. But your landlord can raise rent because housing is an asset that appreciates with money printing. You're squeezed from both sides. This is the parasitic loop. Asset inflation without wage inflation. So why doesn't Congress stop this? Simple. They benefit too. Members of Congress are allowed to trade stocks while in office. In 2021, at least 78 members of Congress violated the Stock Act with 0 criminal prosecutions. The Fed itself is staffed by people from Wall Street who return to Wall Street. It's a revolving door. Robert Rubin, Goldman Sachs to Treasury Secretary to Citigroup. Henry Paulson, Goldman Sachs to Treasury Secretary. Timothy Geithner, Fed and Treasury to private equity. They're not going to dismantle a system that made them multimillionaires. Let me read you what the Fed's own organizational charter says.
Each Federal Reserve Bank is supervised by a board of 9 directors, 6 of which are elected by the member banks. The banks supervise themselves. The incentive structure is perfect for wealth extraction. Politicians benefit from rising asset prices, Fed officials get lucrative private sector jobs, banks get first access to printed money. The wealthy see assets appreciate. The only people with the wrong incentive are you. And here's the most insidious part. They've convinced half the country this is normal. But look around. Is 40% rent increases stability? Is pricing an entire generation out of homeownership stability? This is the crisis. We're living in it. It's just slow enough that you're told it's your fault for not working harder. The wealth isn't trickling down. It's being systematically siphoned up. If you think 2008 was bad, the modern system is 10 times more dangerous. In 2008, Lehman Brothers collapsed over a weekend. Today, 70% of all stock trades are executed by algorithms. When volatility triggers simultaneous algorithmic selling, entire markets can collapse in minutes. The Fed's balance sheet is now the collateral for the entire global financial system. When one domino falls today, it's global systemic failure. Your savings are being slowly confiscated through inflation. If inflation runs 7% and your savings account pays 0.5%, you're losing 6.5% of your purchasing power per year. In 10 years, your $50,000 in savings has the purchasing power of maybe $27,000 in 2024 dollars. That house you're saving for, every year you wait, the down payment requirement rises faster than you can save. You're running on a treadmill that's speeding up. Federal debt is $35 trillion and rising by $1 trillion every 100 days. That debt must be financed. Who buys it? The Fed, with printed money. This accelerates until something breaks. You can't vote out the Federal Reserve Board. They're not elected. But you can understand the game. You can position yourself accordingly. Your parents could ignore finance and do fine. You can't. The system is extracting too aggressively now. You need to own assets that appreciate with money printing. Real estate if you can, stocks, potentially alternative assets. The worst thing you can do is only hold cash and bonds. That's the slow motion wealth destruction guarantee. Complexity is camouflage. They make the system deliberately complicated so you won't question it. They use terms like quantitative easing and balance sheet normalization. It's wealth transfer dressed in a suit. Every empire thinks it's different. Rome thought their currency debasement was necessary. Weimar Germany thought they could print their way out of debt. We think we're smarter. We're not special. We're just further along the same path. So I'll ask you, are we wiser now or just walking the same path in better suits? Because the mechanism hasn't changed, only the marketing has improved. If this opened your eyes to how central banking really works, hit that subscribe button and turn on notifications. Share this with someone who thinks the system works. Send it to a friend who's struggling to understand why they're working harder and getting nowhere. And drop a comment. What year do you think the next major crisis happens? 2025? 2028? 2030? Because the algorithm tries to bury financial truth that challenges institutional power. But together, we're bypassing the gatekeepers and bringing the receipts directly to people who need to see them. This isn't over. This is just beginning, and you need to be ready.